Welcome to the Horizon Investments first quarter 2019 review and 2019 outlook. My name is John Drozzle, and I am joined by Dr. Mike Dixon, who is our head of portfolio management, and Calvin DeBoer, our director of technology. Today in the call, we're going to cover a few important items. The first of which is the Q1 market review and the Q2 2019 market outlook. Mike will cover that for us. We'll then hand it over to Calvin to give you an update on some really exciting tech developments here at Horizon. And then I'll come back and give you some updates on the company. So let me start by turning this over to Mike. Mike, what happened in Q1?
Thanks a lot, John. For a Q1 review, we really saw a rebound in global assets, not just stocks, but also bonds and commodities. And as a reminder, 2018 was a year where diversification really failed, and nearly all asset classes suffered losses as correlations really spiked on losses. But, here in Q1, we really saw gains broadly in global markets and not losses. And so, additionally, we look at some of the other major stories for the quarter. And really, here's what we saw. So we've got the Fed pivot at the beginning of the year is really what the real catalyst was for this cross-asset recovery. Another major story, of course, is China, really on two fronts. So first, you've got the improving trade deal discussions between the U.S. and China. And second, while somewhat overshadowed by the trade deal, there's a large amount of Chinese stimulus that began last summer that's really starting to show up in the numbers. Next, you've got the Brexit story, which has really dominated a lot of the headlines in the Eurozone. And, while no one knows the final outcome of this situation, it'll certainly have a big impact. And then finally, global growth. We're going to talk a good bit more in detail about this in the next few slides and why the global growth story is so important and focused right now and is really what's required for the next leg higher in global equity markets. And so, putting this rebound into focus, this quarterly chart of the S&P 500 shows just how historic the swings we had, in 2018 were and here in Q1. And so Q1 was the best quarter since 2009 after the recovery of the financial crisis. And this was following Q4, which was one of the worst quarters since 2011. Let's not forget also how historic 2017 was for the opposite reasons. Really, 2017, we had some of the lowest equity market volatility in the past 50 years. But going on to the next slide here, I want to talk a little bit about really why we saw this rebound this quarter. And I think it all starts with valuations. And so what we have here is the S&P 500 PE ratio through Q4 of 2018 and into Q1. And what has happened is valuations have completely retraced their move while the growth story hasn't really changed that much. And I think this all comes back to these key risks in the market. And so think of it this way, valuations are a great way to view the market's perception of risk. And so when valuations are high, you can interpret this as the market willing to pay a higher price for every dollar of earnings because the perception of risk is low, and vice versa for low PEs. And so if we rewind and go back to the end of Q3 in 2018, here were the key risks. Trump was going to get impeached, midterms are going to be a landslide, the China trade war was in full swing, and stimulus was really barely being discussed there. Brexit was a total disaster, and the Fed was going to hike us into a recession. All of these headlines really increased the market's perception of risk. You had valuations contract, and the market followed. But here on the next slide, we can see that growth expectations haven't really changed over the last 6 months. The top chart shows blended forward 12-month earnings estimates for the S&P 500. And it's pretty much the same today as where it was 6 months ago. And so this means the Q4 sell-off and the subsequent Q1 recovery has been all about the market's perception of risk, while the growth story really hasn't changed. And so consequently, the market is back to the levels that we had at the end of Q3. And so let's go back to these key risks, right? The midterms were really as expected. The Trump situation is fine. China and the U.S. are getting along, and the China stimulus is really beginning to take effect. Brexit has been delayed. And finally, of course, the Fed couldn't be more dovish. And so the key takeaway here is that the market is already pricing in good outcome scenarios for these key risks. And therefore, the narrative has shifted much more towards an intense focus on global growth, which is necessary to take equity markets the next leg higher. And so when we talk about this growth story, here we look at in the U.S. and the Fed forecast of some very key economic indicators. And what we see is continued expectations of healthy GDP growth, a healthy job market, and stable prices. There's certainly no sign of a recession, which was intensely feared in Q4. But here at Horizon, of course, we're a global asset manager, and looking to kind of a Q2 outlook, we're really focused on global opportunities. And so when we look at global markets, the growth story presents some wonderful opportunities for both strategic and tactical allocations. And so in this top table, the global macroeconomic conditions really show that the U.S. and China are the sources of economic growth, and the global employment picture does remain pretty healthy currently. Now, when we turn to the bottom table, looking at valuations and corporate earnings, we can begin to paint a picture about how we at Horizon think about the use case for some of these broad markets. First off, to notice that the U.S. really shows very low earnings yield, but strong expected earnings growth. And so our interpretation here is that the market perceives risk in the U.S. to be quite low, but still capable of some strong growth. And so our portfolios will continue to reflect a strategic overweight to the U.S. because of this. Additionally, let's look at China, where earnings yield is actually quite high, but growth is also strong. We take this to mean that the market expects China to be somewhat risky, but still a strong source of global growth that is really enhanced by their continued stimulus, which has really started to take a big effect now. And so our portfolios will continue to reflect a strategic overweight to China and emerging markets, really kind of due to this interpretation. Now, when we talk about developed markets, we're going to be using these regions a little more tactically. What I mean by that, specifically, Europe can be seen as fairly risky. And so we view Europe as a kind of a more deep value tactical play. On the flip side, Japan in developed markets can really be viewed as the safety play. And so we're going to be tactically using Japan from time to time for more defensive exposure as we see fit as the global growth story kind of unfolds. And so finally, we have to say a few words about the recent headlines of an inverted yield curve on our final slide here. And here's our take. Just relax. The inversion does not mean a recession. If you look at point 1 on the graph, the yield curve reached levels similar to where it is today in late 1994. Subsequently, the market rallied more than 200% over the next 5 years. Again, if we fast forward to point number 3 on the graph, the yield curve again hit these levels in late 2005. However, following this inversion, the Fed subsequently hiked rates about 5 more times, which the Fed has told us today they're definitely not going to do. And so, today the picture is just a much different story with the dovish Fed. And our view really is that we're much more similar to a mid-90s environment, which we believe we could see continued growth for years.
Well, what a difference a quarter makes, Mike, right?
Absolutely.
So it sounds like we're constructive on the equity markets.
We are.
That's great to hear, and I'm sure advisors would like to hear that as well. Well, thank you, Mike. I'd like to turn this over to Calvin DeBoer to give everyone a quick update on some of the developments in our technology area. Calvin?
Thanks, John. And before we dig into some of the granular updates, let me take a quick minute and kind of refresh your understanding of why we're building technology in the first place. There's a variety of problems we see with some of the advisor technology in the industry and some of the problems in the industry more broadly. And one of those areas that we've concentrated on really in the last couple months is product transparency and giving to advisors the detail, daily detail, timely detail they need on strategies, particularly our strategies. And so earlier this year, many of you will have seen some of the enhancements we made to the Risk Assist Monitor tool. Recently, we added push notifications to that for those advisors who'd like to subscribe to get those notifications on their phone. For some of you, this may be news to you, and would love to invite you to come to our Horizon dashboard and sign up for those notifications. And coming up this year, we've got a lot of great things sort of on the schedule to continue to enhance your experience in the dashboard. Things like an enhanced Portfolio Explorer and some integration into your CRM tools. We continue to welcome feedback and ongoing criticism, but to some of the things we're doing. We love to hear from advisors. This is a software that is for advisors, by advisors. And on this slide, I just want to give you a quick picture of how to sign up for some of those alerts I just mentioned. All you got to do is sort of log on, click on the bell, or go to the settings, and you can opt in to either text or email alerts. And I promise we'll not send you anything that you don't want to get. So we're going to allow you to be very targeted in what you receive. This isn't a spam campaign, but rather targeted strategy updates, and really looking forward to seeing you on there.
So Calvin, I've talked to many advisors this week, and many of them have signed up for the Risk Assist alerts. By the way, so have I. They're fabulous. So I would echo your your comments. I would strongly urge all advisors to, if you're interested in Risk Assist, sign up for the alerts. They're a terrific way to stay informed.
For sure, and I'd invite you, if you haven't had the opportunity to sign up for an account on the dashboard, please go there and click Create an Account at pro.horizoninvestments.com. That's pro.horizoninvestments.com. We'd love to have you on board.
Terrific. Well, I also wanted to take a little bit of time and give you an update on the company. I get asked questions all the time about how are you doing at Horizon? So, thanks to you all, we're doing quite well, and we're grateful for your support. I have two updates around territories. We've created 2 new territories, and we've placed regional directors into 2 new territories. One is called the Plains States, and the other is called Pacific Northwest. And if you go to the website, you can get the information on the RDs that are occupying those territories with their contact information. And we've also added an additional resource to our sales desk. So we continue to reinvest in the company to make sure that we're communicating effectively, that there's a level of transparency that you all are comfortable with. But it's not just in sales that we're investing in the company. We continue to invest across the company in marketing, in portfolio management, in compliance. And so again, we are grateful to your support to allow us to continue to do that. And then in a more general framework, just to give you an update, 2018 was a record year for Horizon Investments in both AUM and revenue, and we're grateful to you all for the support. And the first quarter of this year, we've continued to benefit from the support of our advisors. And then the last thing that I wanted to share with you is that we're in the process of revamping our commentary, and you will be hearing from us around that sometime in the second quarter. So we look forward to providing you with all the market intelligence that you've come to expect from us. So that's all from Charlotte. We're grateful to you all for your support. We'd love to stay connected with you. Please feel free to reach out to our sales desk at 866-371-2399, extension 202. Of course, you could always email us at sales@horizoninvestments.com. And always please visit our website at horizoninvestments.com. Again, we're grateful for the partnership, and we look forward to catching up with you all soon. Thanks so much.